Hey everyone, happy Monday, April 14th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny, actually quite warm, high in the 60s kind of day here in Redmond, Washington. Hope you are all doing well wherever you're at. Hope you had a long, wonderful, and restful weekend. We did here in the Keller household little club soccer with the little one, little relaxing now that we're all home from spring break and enjoying some nice weather here in Seattle. Before we get to this week, great to be back here in the home office with the normal setup. Doing things remotely at off hours was a challenge, but thanks for hanging with me, those of you that tuned in on last week's episode. We actually had a really good mailbag episode on Friday, I want to say, so please check that out if you missed it. Some really good, thoughtful questions, and gave me some time to go through a lot of different charts in a little more detail than we have a chance to on the normal episode. Kind of a choppy M-shaped kind of day. The S&P making a high about an hour in today, making another high just below that same level, just below 54.50 in the last hour of trading, fading going into the close, but overall decent up day, and that's how I would sort of describe it. Some gappy names that traded lower, looking at some Magnificent Seven stocks. I think I grabbed one or two of those. Actually, I'm pretty sure I grabbed Apple with two different charts to show you where I think we're at with the chart of that. And also highlighting some of the Magnificent Seven stocks testing key moving averages. That's something we're going to focus on this week because the question is, does the S&P regain the 200-day? That's pretty high above, I guess, not that far above current levels, depending on how far you think is far, but certainly something we could be talking about. But I would say names like Meta and Amazon really need to push above their own 200-day moving average if the major benchmarks have a chance of addressing their own. Should be fun today as we get to the charts here and break down the market action. So let's get to it. The S&P 500 closing the day around 54.06. That's 0.8% above Friday's close. The NASDAQ Composite a little better, 0.6% higher. The Dow, the best of the top three, up 0.8%. Mid caps and small caps both up even more. And the mid cap S&P 400 up 1.2%. That's the top performer here on page one. The VIX drifting lower, almost 7 points lower. That is still pretty high. And I think that's the reality of the VIX sort of spiking up and staying up in this kind of 30 to 50 range. This is a high volatility environment, which means a day like today, which is a relatively low percentage swing kind of day, is the exception right now, not the rule. I guess we didn't have some huge market moving headline before the open. So I guess thankful for that. We did have plenty of headlines starting Friday evening all over the weekend, but today kind of lightened up. So that's good. So I had a bit of a break there, but overall, I mean, volatility is pretty extreme, which means, I have a lot of questions about swing trading, a lot of questions about how to play this move. I mean, some people finding this excessive volatility as a great opportunity to play intraday swings. I think that is a dangerous game. Personally, it's not where I tend to focus a lot of my time. For me, more as a position trader, this is the kind of environment you just want to wait and see how things play out. I'm with the volatility this high, it's a lot of noise and much less signal. It feels like in the moment-to-moment movements, I guess is my impression with that short-term time frame. All right, let's look at some of the other asset classes here. You can see rates overall moving lower today. The bond market strengthened for one day. The TLT was up 0.7%. That's a long duration treasury bond ETF that we track. The yield curve basically down across the board. The 10-year point, which is the main one that we follow, finished today around 436, and that's down obviously from Friday's close. That is, Friday closed around 4.5%. Now we're below 4.4% on the 10-year treasury yield. So bonds strengthening a bit along with stocks today. The dollar index down about 1/3%. Still not seeing a big influx in the U.S. dollar. I think that weaker dollar may be the most concerning thing I'm watching right about now, besides just the general downtrend in stocks and general noise with things like volatility. Looking at the commodity space, the DBC, which is a broad commodity ETF, essentially was flat for the day. Gold ETF GLD lower by 0.6%, silver higher by 0.6%. So sort of one up, one down there. Copper prices moving higher, crude oil slightly higher, but not by much. Energy did not have a great day necessarily. Looking at the cryptocurrency space, I mean, Bitcoin having a pretty decent weekend, currently trading just below 85,000, and that's making progress, right? I mean, almost looking like a higher low, or at the very least, a bullish momentum divergence as we're testing sort of the upper end of the range here. Stocks not giving that kind of bullish divergence, but you're seeing a bit of that with Bitcoin. So Bitcoin currently up 1.2%. From yesterday's close, sort of the end of trading, or the end of the 24-hour period yesterday. Ether prices up as well. Looking at the 11 S&P sectors, again, great up day. I mean, the market was not down, but look at the leadership, right? This was not sort of an offense over defense kind of day. It was the opposite. Your top performers, real estate, arguably one of the most defensive sectors, up 2.2%. Utilities, number 2, up 1.8%. Consumer staples, number 3, 1.7%. Healthcare, number 4, basically tied with materials, up 1.2%. So the 4 top performing sectors are pretty much the defensive sectors I would list out. If you ask me to pick the top 4 defensive sectors, that would be them, almost in that order, to be honest with you. I mean, those are pretty defensive areas. Probably wouldn't put utilities as the most defensive because there's sort of growthy aspects in there recently, but certainly defense over offense, the story today. Consumer discretionary up the least. So all 11 sectors higher, but consumer discretionary up about 1/3%, about the same for energy. Communications stocks up about 2/3%, followed by technology. So the challenge on a day like today, the S&P and the NASDAQ were positive. That's good, I mean, generally. But the leadership themes certainly not giving an all clear, things are getting better type of vibe. This is more of a rotational, getting more defensive vibe, to be honest with you. Looking at the breadth, it was actually surprisingly strong for how kind of choppy, noisy, flat today was. Breadth was actually remarkably strong. The S&P 500, 85, 86% advancers, 14% decliners. It's pretty bullish configuration. The NASDAQ slightly less bullish, but still fairly constructive, about a 2-to-1 ratio of stocks higher versus lower in the NASDAQ composite. So this was a nice, broad advance. Most things finished in the green. So that's encouraging. Our market trend model, not a lot of goodness to report here. This is no change from Friday. So on Friday's close, I have the again, no change in my model for a month or two now. The main model, which is the S&P 500, bearish short term, bearish medium term, still bullish long term. Now the short term model very close to flipping positive. If we would get sort of further dribbling to the upside, you could see the short term flag turn bullish, which would say tactical bull, cyclical downtrend, long-term uptrend, which is pretty much how this market feels right about now. The long-term model actually already flipping bearish for mid caps and small caps. Certainly something to continue to watch this week. Looking at the Magnificent Seven and friends here, some leading growth stocks. And again, here's where I think the issue is for this market is for the S&P and the NASDAQ to push higher, for the S&P to push above 5,500, for the S&P to continue above its 200-day moving average, you need the generals, you need the big weighty names moving higher. And if they don't, stocks could be moving higher. Maybe the equal weighted S&P looks a lot better, but the cap weighted S&P is really dominated by these stocks, and they're not as a group doing as well as you'd want to see. Apple up 2.2%. And Apple is probably the biggest beneficiary of the crazy headline flow we've observed over the last couple days with, technology stocks being, removed from the tariff list. And then the latest comments now, no, it's actually just a procedural thing. They're definitely going to be included. I'm not sure what to believe at this point besides look at the chart. And for today, the chart's going higher, but I would say Apple, still with quite a lot of proof from a technical perspective. Netflix, arguably the best of this group, up another 1.4%. That's interesting. That's out of all of these stocks, the one that's looked the least bad, hands down, Netflix. So that's continuing to go higher. Alphabet up 1.2%. The problem's on the downside. Meta down 2.2%. Broadcom down 2%. Amazon down 1.5%. Nvidia basically flat for the day. And stocks like Nvidia, opened higher, right? They sort of gapped higher at the open, but the open was the high of the day, right? The close back towards Friday's close. So Nvidia opened around 115, but closed back around 110, 111, right where we were on Friday. So those gaps higher being sold is what concerns me about the current configuration in this market, particularly looking at some of those leadership names. All right, shall we continue on looking at the market carpet? As a reminder, I can see questions that you're asking on all the places we're streaming on Facebook, LinkedIn, YouTube, and X. Those of you tuning in live, I appreciate you so much doing so. Hope you find these reviews helpful, and I appreciate the great questions you guys are throwing in during the show. At the end, I'll grab a question or two and to answer, and anything we don't get to, we will put in the mailbag. Planning another mailbag episode Friday of this week, and we'd love to answer one of your questions on the show for sure. Looking at the market carpet here, obviously a fairly constructive day, right? And you can see a lot of green in a lot of different places. Particular areas where you're seeing a lot more green than average. Healthcare with a surprising number of up days. Stocks like Amgen, biotech companies, right? Amgen, AbbVie, Gilead, bouncing. And again, these are still making short-term patterns of lower highs and lower lows. These are stocks that have not really had a bid in a while. All sort of bouncing off of weaker levels. Vertex bouncing off 475 mid last week and now rotating higher, pushing toward $500 a share again. I like the rotation I'm seeing in some of those areas for sure. Real estate and utilities, two fairly defensive sectors. You can see a lot of green down in those two sectors, as we mentioned in the sector recap. Really showing some strength. Financials as well. And financials are key because a lot of these names are reporting earnings this week. Today we had Goldman Sachs, which we grabbed the chart of, but like Citigroup, BAC, Bank of America. These have not been particularly strong charts in 2025. To be totally honest with you. The areas of the market, the areas of the financial sector showing strength have been in other areas, things like exchanges, ICE, CME, things like insurance companies like Progressive have looked way better than money center banks. But we're getting a lot of earnings on the big banks, also regional banks through the course of this week. Could be some really important charts to show. What's interesting is a lot of those, it may give you a little skewed impression of earnings, I guess, because a lot of these could probably be feeling very good because of the incredible amount of volume that we've been experiencing here in the last couple of weeks. So that's probably a good sign. I think when we get to some of the consumer names, some of the manufacturing names, and we start to hear about how everyone's dealing with potential tariff impacts, I think that's where this earnings season could end up weighing on the market more than a lot of people might want. In the technology sector, I'm noting Microsoft and NVIDIA. Again, not big down days, just really not moving higher. So kind of stalling out here. And I think that's the risk. Last Wednesday, by any stretch, an incredible bounce higher, 100% agreed. The question is the sustainability of the advance. We're still below where we were when the market gapped lower on that initial news about tariffs. So we haven't even regained back to that point we were already going down for a month or two before those, that tariff announcement a week and a half ago. So what concerns me is that real excitement off of those lows. Once we all sort of digest that gain, that short-term gain, and then, take a look around and see what the conditions are, think about the prospects for economic growth with any sort of tariff. So, again, just making it a little harder for economic growth. I feel that nets out to a negative trend in stocks would be my guess. We'll see. We'll see if we're able to reclaim some of those key levels. Also noting airlines, by the way, I think it's American reporting later this week. I don't have that in front of me. I apologize for that, but I'm noting some of the airlines kind of down here. Southwest, the worst performer out of the S&P industrial names. That's a group to pay attention to because that's one area, given a lot of the changes in the federal government and all sorts of question marks in the U.S. Latest evidence or latest updates from airlines have been less demand for domestic travel. And that's going to weigh on some of those charts most likely here. That's kind of where I'm at with it. And boy, just meta jump. These names that are down big today, like United Healthcare, is kind of an interesting one because that's been one of the better charts in the last 6 weeks, coming off of a February low, testing $600 going into the weekend. Actually pulled back a little bit today. Amazon down 1.5%, Meta down 2.2%. Those are the charts that kind of jump out and concern me a little bit, because you'd really need to see those look a lot better, just to provide enough upward momentum for the S&P and the Nasdaq. All right, here's a daily chart of the S&P 500. As I've mentioned, previously at random times, the bolder and thicker I make the trend line, at least when I'm drawing it, it seems really important. That's the thing I can tell you. These are not scientifically drawn trend lines. These are more just visual representations of what I see as a very important sort of theme or trend to follow. One of the things you're going to find as we get to some of the charts here through the remainder of the show, particularly when we get to some of the individual stocks, is a lot of stocks you can draw clear trend lines from the February peak or the peak in early 2025, and then a secondary peak that happened maybe in March, maybe early April. For some of them, I've drawn a couple trend lines because the downtrend is accelerated, and so you have to draw steeper trend lines to match the increasing slope of the decline. It's called accelerated trend lines, is the technique that I'm using there. Not on this particular chart, but on some other ones that I'm gonna show you. And I think tracking where stocks are relative to that trend line resistance could be a good way to sort of validate this rally that we've seen. I mean, the rally from 48.50, even a little less than that, to 54.50, which is a level we reached today, pretty impressive, right? We're claiming almost 50% of the decline from the February peak to the early April low. The question is, do we have enough momentum to continue higher, right? Because this is sort of a, tariffs are bad. They're not going to be as bad as we think, is kind of what that chart is doing with this V-shaped bottom here in the last couple of weeks. But getting back up above the the 5,500 level, getting back above the 200-day moving average, which is currently at 57.50. I think if you're getting up at this point, that would have to be because of renewed optimism for economic growth. That would have to be optimism that we've not seen since mid-February, that things are just going to get better and better from here. And I mean, the vibe I get from any of the data that I'm seeing, less headlines, but more actual data, right? Economic data, consumer sentiment, earnings, which is going to be the big, fire hose of information we're going to start getting, really starting on Friday of last week and now continuing over the next 3 weeks. I'm low confidence that we power up, in a meaningful way, driven by new optimism. I feel like the evidence is going to continue to probably be more negative. If it isn't, then there's your catalyst to go to the upside. And if earnings are a surprise to the upside, again, I don't see that as likely. We'll see. But I would say, what would we need to see for me to have less of a cautious tone, which I'm sure you pick up on, as I sort of look with great skepticism on this rally. If you remember back here, I was talking about, boy, this feels like a counter trend rally within the downtrend, and we kind of made a new low. And I'm feeling this very much feels still like a bear market that's not done yet to me. We have to get above 5,500. We'd have to get above this trend line, because, those kind of things sort of tell you this is enough. The RSI pushing above 50, ideally pushing above 60, which tells us we're in a new bullish regime. And, Paul Tudor Jones, nothing good happens below the 200-day moving average. Now, there's a big move from 48.50 to 57.50. And that's a 900-point swing just to get back to the 200-day moving average. But it's starting to slope downwards. And what happens now, the way the math works, is the longer we spend down, every day we spend down here, the slope's going to get lower, because you're rolling off something back here and you're adding something down here. And so you're rolling off higher levels and adding lower levels, and the moving average starts to slope. That's sort of a way you think about moving averages, is think forward about not just what new data is coming, but what's rolling off from 200 days ago. And that's going to cause the 200-day to start to slope downwards. So that threshold to get a more optimistic look is going to get easier and easier as the moving average starts to slope downwards here, probably over the next month or two, would be my guess. So that's kind of where we're at with the S&P. Again, I mean, based on what I'm seeing, this is an aggressive upside move, but again, with my models, with the momentum, with the trend, I'm still fairly skeptical. Now, what are we seeing that's validating the fact that this tactical bounce is meaningful, which I think it undoubtedly is in some way? The bullish percent indexes were all below 30%, and as of today's close, just finally breaking above 30%. I cut a video. This was last week. for Stock Charts TV, and I had some publishing issues last week. So I think it was Wednesday. It probably went up on Stock Charts, the Stock Charts YouTube channel. So if you check it out there, you'll see my latest video talking about bullish percent indexes. But basically, the idea is you need to wait when they're this low, getting down to 6%. That means only 6 of the 100 members of the NASDAQ 100, as of about a week ago, were in a bullish point and figure signal, right? Which means 94% of them have most recently registered a sell signal. That's a market in a broad decline according to the point and figure charts. Now we've gotten all the way up to like 39%, up from 6%, which means a full third of the NASDAQ 100 since last Wednesday have registered a buy signal on their point and figure chart. That's not nothing. And that tells you that there are enough stocks bouncing that we're in at least some counter trend rally. If not, the low might be in, and it could be. I don't know for sure, as much as anyone else does not know either. But I will tell you that this indicator getting above 30% is very similar to previous tactical buys that we've seen, right? So August 2024, we got right down to 30% before we popped higher. Here in April of last year, just before the rally there, we hit 30% in October of 2023 before turning higher. So getting down to that level, which we actually did in the second week in March, just before that bounce. And we did get there last Tuesday before the Wednesday rally off of the lows. But actually, we got there about a week before that, right? So this was like early last week. We got down to 30%. We just got a lot lower. Then before that huge rally, it had gotten all the way down to 6%. Then on that bounce higher, you started to see a bunch of stocks register buy signals. So for now, this says at least short-term bounce, which is, again, what we're experiencing right now. The problem I have with this indicator as a long-term signal is if you look at this signal look at this chart over the last 25 years, you will find times, and this is what we went through in the video, you'll find plenty of times where there'd be a big initial sell-off. You'd have a rally where the indicator would have this exact configuration, but then the next big leg lower just kind of reinitiates it. So this is more about tradable rallies and less structural changes. That's where I think we need to look at other indicators to supplement them. Now, the VIX has been coming down. It did peak on a closing basis just above 52 about a week ago. From there, we've seen a big decline in the VIX. We've seen a big decline in the MOVE index, which is like the VIX for the bond markets. Both of those still very high, though, relative to historical standards. So a VIX above 30 is a relatively small number of observations looking back over time. Often have been around meaningful lows, 100% true. Often have been within extended bear markets, which is also true. But generally, the VIX remaining in this extreme range tells you to expect those big swings. In my podcast, it's probably been a month ago now, I interviewed Jay Soloff. And if you missed that interview on the Market Misbehavior podcast, please go back and listen to that, because it was a little mini masterclass on what the VIX actually represents, what levels in the VIX tell you about expectations for daily moves in the S&P 500. And given the levels that we're at, with the VIX this high, it basically just means expect daily moves in the S&P to be big, to the upside and to the downside, both ways. And so it's going to be a noisy, super choppy environment until the VIX starts to decline, gets back down to like the low 20s. That's when you can start to think about a different volatility regime. For now, big swings. And again, today was one of the least big swings we've seen in a couple weeks, but that seems to be an outlier for now. Now, with all of that said, right, with the sort of counter trend bounce off of last Tuesday's low, where does that leave us? So I would say from a leadership perspective, it's still defense over offense. This is a ratio of the XLY to the XLP in the top panel. On the bottom panel, it's the equal weighted ETFs for those same two sectors. I love this comparison because it's basically things you want versus things you need. The reason why this ratio is so powerful is because XLY, the consumer discretionary, is very sensitive to economic, sentiment, to investor sentiment, because when people have extra money, when they feel confident that they can spend money, they tend to do it on luxury goods, discretionary purchases, travel, tourism, new clothes, new expensive things. consumer staples are things that are sort of immune to economic shifts because you still are going to buy beverages, tobacco, cleaning products, personal care products, things that no matter what's happening with the economy, no matter how much extra money you have, you're still going to buy those basic human necessities. And that's kind of the idea. So when this ratio is going higher, basically the market is telling you there's this assumption that consumers are going to be spending more than and more on discretionary purchases. When the ratio has been going down, which it really has on the cap weighted ratio since mid-January, on the equal weighted ratio since mid-February, it's been clearly favoring defense over offense, basically suggesting investors getting more conservative, more defensively positioned. That's just not usually the way that the market rallies significantly. You really want to see that ratio turn higher as a reason to be more optimistic here. A couple more charts, then we'll take a question or two from the chat today. This is a chart we're going to look at every day this week. The question is, will the Mag 7 reclaim the 200-day? And I know this is only 3 of the Magnificent 7 names, but there are 3 that are actively testing their 200-day. You have Netflix kind of way above it. You have stocks like Apple kind of way below it. But these are 3 that are actually testing resistance, right? So with Meta, the 200-day currently around 578. For Amazon, the 200-day at 200. For Tesla, the 200-day right above $290 a share. All 3 of these have actively tested the 200-day moving average in the last month. All 3 of them have failed to regain them. And even with that big move last Wednesday, none of them were able to get a sustained push above the 200-day moving average. And so I think unless you can get stocks like these, and I think these in particular pushing above the 200-day, I just don't see a sustainable upswing from here as a reasonable expectation for the S&P and the NASDAQ because there's just too much market cap represented in these particular names. So one of the charts we will follow closely for now, all 3 of these opening above Friday's close, all 3 of them closing below today's open. So you saw distribution through the course of the day. We mentioned that with the chart of Apple, which we have in a minute here as well. All right, here's the semiconductor ETF. This is that concept called accelerating trend lines, which is when you draw an initial trend line, in this case in a downtrend off of 2 major highs, but then the price gets really far away from the trend lines. And so you need to draw a secondary one that matches the new points. And you can draw another one if it even accelerates further. I've not drawn a third one just yet. Just waiting to see where we're at relative to that trend line resistance. But, again, this is the semiconductor ETF. Great bounce off of the lows, but again, take a step back and I'm seeing a clear pattern of lower highs and lower lows that for now is unbroken. And until we get above trendline resistance, until we get stronger momentum, which suggests a real influx of optimism or demand on semiconductors, it's still not a great chart. Here's a chart of Apple. And again, one of the more concerning things I saw today was the fact that Apple opened higher. Now, this is after, the headline Friday after the close that hit, saying that, electronic devices and other, Apple-like things were going to be not part of the U.S.-China tariffs. And then that was a whole story that was run on Saturday. And then yesterday, language from Wall Street or from White House representatives basically saying, no, it will be, but in some other way. No one's free from these tariffs or no one's immune from them. We'll be looking at that space in particular. It just might have its own specific language. So, Apple after Friday's close certainly felt like Apple was just going to shoot to the moon today if all of a sudden their biggest threat to their business was removed. But now a lot of question marks. So that gap higher on the open sold off. And by the close, we're back down to around 203. We opened around 212, down about 10, another 5% off of the open down to the close. That's did end up closing 2.2% above Friday's close. But I think the distribution during the day tells you people are not just falling all over themselves to buy more Apple today. It was people thrilled to cash out and just unwind before something bad, before that next thing happens, I guess. Now, the weekly chart of Apple, we did highlight on the show last week. This is the weekly chart showing the 40-week, which is similar to the 200-day, and then also the 150-week moving average, which is one of the averages I like to have on the weekly chart. It's a good kind of long-term, very long-term kind of secular trend type of indicator. Apple's been above its 150-week moving average for years and years and years. The most recent tests were in April of 2024 when it held, December of 2022 when it briefly broke below for a couple weeks before rotating higher, end of 2018. I mean, you see how rare it is that Apple's even gotten down to this, but it's never really broken it. I mean, you have to go back a lot further to find some breaks of that 150-week moving average. Last week, we opened below it, but closed back above it. Does that hold through the course of this week? And if not, that's where I think the next big leg lower probably involves Apple breaking below its 150-week moving average. That'd be my guess. All right, we are starting to get into earnings. Not a ton of earnings to report yet today, but through the remainder of this week and probably the next couple weeks, we'll be hitting on a couple earnings names every show because it's just going to be big catalysts, often a binary jump to the upside or the downside. We can see the chart of Goldman Sachs. I don't have that trend line drawn, but you can see where it would be right up here. Lower highs, lower lows. Big money center banks started Friday. We have today with Goldman, tomorrow with like Citigroup and Bank of America. We can look in the after hours to see what's happening with something like Goldman Sachs. Basically flat. It was a little bit lower right after the close and kind of flat now at this particular moment. We'll see what happens as investors digest that news, but it's going to quickly revolve from or rotate from banks and regional banks through the course of this week into other sectors. Netflix is the only FANG name reporting this week, if I remember right. I got a mailbag question about Costco. I didn't get to one on Friday, but I just wanted to include the chart here. I mean, Costco is really kind of trapped in no man's land, right? And it's sort of in moving average purgatory, which is where we're kind of right between the 50 and 200-day moving averages, right? The 200-day moving average is around 922. You can see we actually broke briefly below it in March and again earlier this month in April, but both of those times we soon after bounced back above the 200-day. The 50-day has served as resistance since that gap lower. And note that all of that is happening right below $1,000 a share. So, while we could look at a couple different things, I'm going to update the chart as we're talking here. While we could think of this in a couple different ways, I guess the way that I generally look at this is really you make it kind of a neutral amber. You've got 1,000 on the upper end. You kind of have like this 875 level, right? This is kind of this rectangle kind of captures the price action over the last 6 weeks. After that gap lower, that gap was right below $1,000 a share, and big round numbers tend to have meaning. That's why this peak at 1,000 makes a ton of sense. The gap below 1,000 kind of makes sense. We've now stalled out trying to get above 1,000 here the last couple times. So I think until we break above 1,000, it's not really suggesting a nice rotation higher. On the downside, your downside risk is down to 875. Anything below that is a much more bearish rotation because that will actually look like a head and shoulders top breaking the neckline if you start getting below those levels. For now, it's getting above 1,000 is key. That's where I would set an alert. I think Costco above 1,000 is a decent chart, at least to get back to the February peak and maybe put in a higher low along the way. That could be very encouraging. The RSI getting very close to 60. But if we stall out again at 1,000, that's where I'm playing more of this range, maybe playing a retest of the 200-day down to those lows from March or April, but certainly sort of an active point here. To finish off with my last chart, then I'll take a question or two to wrap the show. There is a scan that's part of the sample scans on stock charts, and it's called Moving Averages Proper Order or something very similar to that. I love that scan. It basically looks at three comparisons. Two comparisons. Is the 20-day EMA above the 50-day simple moving average? Is the 50-day average above the 200-day average? And if both of those things are checked, then it comes back on the screen, and it's called Moving Averages Proper Order. So you have the 20-day EMA, then the 50-day simple, then the 200-day simple, right in the right order. Beautiful screen to run right about now because very few stocks check all those boxes where they're actually above the right moving averages. Here are three that came on that scan that I ran about an hour ago. O'Reilly, right? Auto parts kind of rallying here over the last 6 to 12 months, but especially holding up beautifully here in the last month or two, pulling back to an ascending 50-day moving average, bouncing higher. AutoZone, others kind of looking very similar. Here's Philip Morris. You can see the tobacco names, bearish divergence, which is a bit of a concern on some of these, but for now, holding an ascending 50-day moving average. I think that's pretty good. Very close to making a new high. Kroger, which is a name we've highlighted, higher highs, higher lows, classic uptrend. So charts that look like this, when most charts don't look like this, are important to follow and important to track. And ideally, these are the types of names that are outperforming in a dramatic fashion in this kind of environment. So look year to date, you'll find charts like this continuing to show strength. I always sign off the show. It's always a good time to own good charts. These look like good charts to me for sure. All right, let's continue on with a question or two, and then we'll be done. JB Mit9, thanks for watching on YouTube. You said gold and silver continue to look very strong. I would agree. How would you approach taking a long position? Yeah, really good question. And it's funny, we don't have a lot of charts like those that are in such protracted uptrends, right? Here's the chart of the GLD. Just as an example of that. And the SLV, kind of similar. It looks a lot like the charts of O'Reilly or Philip Morris or Kroger, right? Kind of above two upward sloping moving averages. This is an ETF with the moving averages indeed in proper order. We did not make a new all-time high today on the GLD because we made one on Friday when it touched $300 for the first time. But overall, this is a chart looking quite strong. There are a lot of macro reasons we could argue why gold and silver are decent bets given the uncertainty. It's a sort of a, serving a safe haven role. And when inflation is a concern, it usually does pretty well. Hasn't always worked out that way, but it's worked out pretty well here recently. Now, the uptrend in gold has been going for quite some time. For me, the goal is to identify charts earlier on in their uptrend, right? To find things that are just starting to break out, to really focus on these kind of moments. When we make a clear resistance level, we have a basing pattern, and then we break to new highs, which is what we call a big base breakout. That's why we talked about gold back here at the end of January and look for further upside opportunity. And it's done obviously quite well. So what do you do today, right? I think there's two general ways that you think of a chart like this that's in a consistent uptrend. Number one, you just close your eyes, hold your nose, and add to the position. And use good money management techniques to minimize downside. If you're wrong and you end up top ticking the market, make sure you limit your losses by using at least some percent stop or using some trailing stop, something based on average true range or something like that. The other option is you wait for an actionable pullback. So I would say over the last week, the pullback to an ascending 50-day moving average is often a really good entry point. When the RSI is pulling below 50 within an uptrend phase, that's where you can often have tactical pullbacks within a longer-term uptrend. For me, the ideal chart is a long-term uptrend, right, where the primary trend is higher, but we're pulling back. So we're making a higher high and higher low, but we're in one of those pullbacks. So you can buy in on weakness. And that's something I learned from years working at, a shop with big growth managers that were running large funds. And it was just really hard to buy into a very strong market because you would just fuel the uptrend because you'd be adding a ton of buy orders. Waiting for pullbacks was a much better way to minimize stress on the market because you're running so much and you're putting in large orders. But the approach, right, the logic of that makes sense. And indeed, a lot of quantitative models do very simple ways of combining long-term strength and short-term weakness. The most common momentum model that I've seen, besides just a simple like 6-month return or 12-month return, would be what they call 12-1. I want things that have a strong 12-month period and then either a weak 1 month period, or I just ignore the last month and I'm looking for, larger uptrends. So short-term pullbacks within long-term uptrends are ideal. So, waiting for a pullback on something like gold or silver to buy in at a higher low, that would be the ideal entry point for me. The other option is you just kind of scale into it as it goes higher. Use good money management techniques to make sure that you minimize losses if the trend is over and if the trend starts to rotate lower. I do see a question about a show on Friday. At this point, I am planning to do a show on Friday. We'll do a mailbag episode. I know the markets are closed for Good Friday. I hope you guys all have a restful weekend, those that are celebrating over the weekend. But for me, we probably will end up doing a show on Friday, just an all mailbag episode to catch up on some of the great questions that I see here. All right, last question. Drew, thanks for watching on YouTube. You asked, Dave, looking at your declining trend lines on your S&P market chart, let's go back there. Yeah, let's do this. There we go. Do you find more likelihood of it being accurate as it parallels your key moving averages? Also, why lines instead of channels? Interesting question. So a couple things you asked about there. So First off, so in this kind of environment, you can draw channels for sure. I would say the chart of the S&P does not really look much like a channel though, because the lower boundary is kind of going down like that. Actually, doesn't come too far off of the low there. I mean, it's pretty. I mean, I can draw it. I guess I don't need to just guess. I mean, you could draw like a trend line down here for sure, and kind of play off of these level. I mean, it's actually not bad. But it's not really like a parallel channel, right? I think sometimes the market looks like it's in a channel, in which case you draw the first trend line, you copy it and draw a second trend line. You find a lot of times it kind of lines up pretty well, but not always. And that I don't really see that on this chart, which is why I don't draw it as a channel. And again, there are kind of like perfect plain vanilla examples where it's like a beautiful trend channel of higher highs and higher lows. The slope is perfect. But then there are other times, and when it fits that mold very well, I draw them on there and pay attention to it. When it's less meaningful, I just I don't draw them on there. So that's why I'm not drawing it on this particular That's why I'm drawing this as a trend line and not as a channel. The other thing to remember is, if my goal, I already know we're going down, so I'm using this trend line as a way of confirming if and when the downtrend is over. I don't need a trend line down here to help me make that assessment. I'm looking here to see when the trend line is broken. So kind of a classic technical approach is, in a downtrend, you draw trend lines off of the highs because we're going down. You just want to know when that's no longer happening. In an uptrend, you'd use the lows because we're going up, and I just want to know when that uptrend is probably ending. And that's what's happening in my brain as I'm drawing that. Does this make sense because it's paralleling the average? I think you just mean because the moving averages are sloping downwards. 100%, right? The slope of the moving average is such a brilliant way of just understanding the change in the trend. And if you get rid of the price and just look at the moving averages, you'll see the 200-day has been sloping higher and then slopes lower. You can see the 50-day sloping higher and then sloping lower. And so that change and the death cross, which may be happening as early as this Friday, really suggesting, a change. Or actually, on the daily chart, is actually happening today. It looks like we're breaking the 50 below the 200 on the Nasdaq. Happened last week. So you're getting these signs that the rotation is very real, and I think that's why using trend lines off the highs makes sense. One final question, and I appreciate someone asking about someone using my name and picture on WhatsApp. I do use WhatsApp, but for nothing involving the markets. I use it to keep in touch with people outside the US. I've heard of a scam that happens with people taking pictures and content from social media and starting a WhatsApp group. Not my game. I don't do a crypto trading service or whatever. I've heard people have asked me about it. It is definitely not me. I wish there was something I could do to make that all go away. Unfortunately, that's one of the negative byproducts of putting a bunch of content out with my face connected to it, is people seem to want to use that for bad purposes, but that's not me. And anything that I do for my own firm and for my own work is on my website, marketmisbehavior.com. So if you ever have a question, go there. There's an email on that website. If you have questions, you can shoot that. That goes to my assistant, who will be able to tell you what is valid and what is not. But I don't do anything with trading on a WhatsApp group, so please don't do that. It's not me. Folks, thank you guys so much for watching me. Thanks for supporting me and Market Misbehavior. I hope you find these market recaps helpful, and I very much enjoy doing them. I hope you pick up on that as well. For Market Misbehavior, I'm Dave Keller. Have a great night, and remember, it's always a good time to own good charts. Take care, folks.